I'm Keith Black with RIA Channel, joined today by Steve Luongo, Chief Investment Officer of Air Asset Management. Welcome, Steve.
Hi, Keith. How are you today?
Very well, thank you. Tell us a bit about Air Asset Management.
Sure. Air Asset Management is a registered investment advisor, and we manage approximately $750 million in assets. The assets that we manage are primarily longevity-related assets, which include life settlements and annuities and structured settlements, as well as private credit assets, which tend to complement our overall portfolio mix. We have been in business for about 10 years, and our flagship strategy, which is Air US Life Fund 2, has a 6-year track record.
So you're getting a fixed payoff at some unknown point in the future based on the mortality of these policyholders. It sounds like there might be some interest rate risk in this investment. So how are life settlements affected by changes in interest rates, given the nature of being less interest rate sensitive compared to other investments?
Well, you're right about that. Okay. Life settlements are less interest rate sensitive with respect to the US dollar interest rate market as a whole. However, that does not mean that they don't react to their own set of level of interest rates that are particular to the market. So let me give you an example. The value in a life settlement is essentially the present value of the cash flows that are tied to the policy. Cash flows being positive with respect to the death benefit that's received at some point in time, and the cash flows being negative with respect to the premium payments that are paid over time to keep that policy in force. And those cash flows are discounted back over an individual's life expectancy, or what we call a mortality curve. Okay. And in doing so, we have to use some expected rate of return. So we have to choose an interest rate by which we discount those cash flows back. And the market as a whole, the life settlement market, where people buy policies from individuals or trade amongst themselves, has a range for established discount rates that are used to price and value the policies. So they're very sensitive to their own set of interest rates and expected rates of return. However, that being said, changes in US dollar interest rates or the US dollar interest rate curve tend to have no effect on the individual value of life insurance policy. They're just not correlated to it. Life insurance policies individually are not priced as a spread, let's say, over treasuries. So in that way, movements in short and medium and long-term US dollar interest rates don't have a direct effect on the value of individual policies.
So it sounds like we're in the neighborhood of fixed income or maybe even private debt. How do we compare life settlements to fixed income and private debt, specifically regarding the returns and the risks?
Yeah, so there's a couple of things. The key thing to realize, I like to view these investments. I like to view life settlements as a true alternative that is really non-correlated to the returns, not only of other traditional asset classes, but also to the returns of other alternatives. And we could talk a bit in a second if you want about where to put these in a portfolio. But many do sort of view life settlements as a form of fixed income or private credit. Because if you think about it, there's a cash flow component to it that is similar to the way a bond behaves. And there's an equivalent yield component to it, which is similar to how a bond is valued. The only difference is that life insurance policies really don't have any stated maturity because you don't really know when mortality will occur. Mortality is really a range over time, and it's probabilistically, or it's determined probabilistically over that time. However, that being said, the question being, how do they compare, let's say, to other instruments, fixed income instruments, and so on? If you look at the returns of life settlement policies, and I'd like to also talk about funds as well, or pooled structures. But if you look at the returns of life settlements in general, they tend to be non-correlated to the returns of fixed income instruments and other asset classes. And that's because the primary driver of return in life settlements tends to be mortality. And of course, mortality does not have a direct correlation to the returns of other markets and asset classes, which may be driven by global macro and so on and so forth. Political events, global macro events, and so on. So to that extent, this asset class has created and carved out a niche for itself that tends to reflect organic non-correlation or minimal correlation to other asset classes.
So tell us about the current economic cycle, the current economic market, and the benefits of investing in life settlements in this regime.
Yeah. Well, I think I'll address the current economic cycle in a second, and I'll sort of talk about the benefits of investing in this regime overall at all times. The benefits of investing in this asset class, when properly managed, tends to be tied to what I like to focus on as being one critical element, which is risk-adjusted return. Using Sharpe ratios, using measures of volatility in relation to return are critical when looking at the returns of different asset classes, because it's the only way you can create a common denominator between those return profiles, because the asset classes themselves are so different, whether it be traditional fixed income, commodities, real estate, domestic or international equities, and so on. So looking at basically Sharpe ratios or risk-adjusted return is the critical way and the most relative way of looking at the return of all asset classes. And in particular, in this particular asset class, risk-adjusted returns generally are very, very strong in relation to other asset classes, which basically means that for every unit of return that we produce as an asset class, the level of volatility is such that the relationship or the Sharpe ratio between those two is generally higher. So we are taking, for each level or each unit of return, we're taking less risk, comparatively speaking.
And when you speak to investors, what questions do they have about life settlements in their asset allocation? Where do you recommend this fits in their asset allocation policy?
We see two things. We see allocations within a general alternative sleeve, and then we see allocations within the private credit sleeve. I think it works in both. We tend to really outperform, as a general rule, most private credit because of just the sort of nature of the underlying performance and so on. In a way, I talked earlier about life settlements being essentially a zero coupon bond with no stated maturity. So to that extent, people like to put it into a private credit sleeve. So you have that kind of designation with, potentially equity-like returns. And then if put into the overall alternative asset sleeve, it tends to have a niche whereby the risk-adjusted returns are quite strong relative to other alternative assets.
And I'd expect that the credit quality in life settlements is higher than in private credit, because your eventual credit counterparty is an investment grade insurance company relative to these middle market unrated companies that are predominant in the private credit space.
Yeah, that's actually that's a great question, and it's true because if you look, let's say from a fund perspective, and for instance, we own roughly close to 1,000 policies, and we're a fairly sizable player in the space. And if you look at the construction of our portfolio, it is almost predominantly investment grade carriers or better. It's really the larger carriers, the larger insurance carriers, and so on. So when viewing it from a hold to maturity point of view, the underlying carrier credit risk is clearly investment grade. So from that perspective, if you look at the returns of life settlements in general, life settlement funds and so on, they tend to outperform, let's say, certainly triple B credits. I mean, I think recently I was checking triple B debt was running around 5.5. And if you look at single B, it's probably in the mid-7 ranges. Now, granted, if you're investing in those bonds, you do have certain liquidity there. But that being said, the underlying credit risk in life settlements and in life settlement funds tends to have a risk premium in it that is above, corporate bonds that may even be of a lower investment grade. And of course, that differential is if you're investing in a private fund, you have added liquidity risk and so on. So, I mean, it's still fair to say though that, if your underlying credit risk is, AA, AAA and so on, single A and above, and you're investing in a private fund, then whatever liquidity risk occurs in a private fund is sort of diluted by the underlying credit quality of the asset.
Thanks for sharing with us today, Steve.
Oh, terrific. Thank you so much for having me. It's a pleasure.